All right, good morning, everyone. Hello, Accounting 219 Managerial Accounting students at Alabama A&M University. This is Waris Karim again with some discussions on problem solving of job costing, cost flows, and external reporting. I'm going to focus on chapter 3 today, and we'll specifically deal with one or two of your assignment questions. We have done some progress, I think, in having you attempt or at least do or start the assignment and quiz of chapter 2, but I haven't seen many of you to actively do anything with chapter 3 yet. So I thought it might be a good idea to have some discussions on specific journal entries, the actual calculations, the schedules, the schedule of cost of goods manufactured, and schedule of cost of goods sold. So that's what we're going to do today. I will start with a brief overview of the chapter, or of, in a sense, two chapters, both the chapters on job costing, and then I'll delve into two of the assignment questions. So what I'd like you to think first is that chapters 2 and 3 both deal with job cost accounting or job order costing. Why two chapters? The purpose of chapter 2 is to get you up to unit cost calculation. So chapter 2 is purely the calculation of the job cost and, if necessary, dividing it by number of units within the job. So that's where your task or your goal is achieved. Chapter 3, on the other hand, is about the actual accounting of it, job cost flows, what happens when you purchase materials, what happens when you issue those materials or some of those materials to different job sites or different projects, what happens when you add direct labor and other indirect expenses called manufacturing overhead. So what happens after those things and how we account for those and how we apply, how we find out a predetermined overhead rate, although we have some discussions on predetermined overhead rate in chapter 2 as well, but chapter 3 is the actual application of it and in everything in much more details. And particularly the items that go in our external financial statements, like the closing stock or value of our ending work in process inventory, the value of ending finished goods inventory, and the value of cost of goods sold. So let's start. I'd like you to recall our job cost accounting cycle. I call it accounting cycle because it is actually an accounting cycle. We start with procurement of materials, procurement or acquisition of raw materials. Then we end with sending our finished goods over to the finished goods warehouse or to our showrooms. To showrooms where we showcase our products and wait for customers to choose. So the whole cycle here, direct from, it's like cooking, that if you're a good chef, you'd like to procure, you'd like to buy or purchase your ingredients. Try to find out the best ingredients, the freshest ingredients from the market, and then process it and then present it to your guests. So our users, financial statement users, are our guests, and our customers are our guests, and we have suppliers, we have workers, we have managers, we have our own processes, machines, equipment, everything to manufacture the best possible product. Remember, cost accounting is not just accounting. Cost accounting, as I said, is precursor to pricing. So if we have efficient cost accounting, if we have a fair cost accounting, then we're going to have a fair pricing. And if you have a fair pricing, chances are we'll be leading the market. We'll have so you are actually assisting your company in staying ahead of your competitors, or at least staying afloat, staying like on course. Okay, all right. So this is the beginning of the cycle. We purchase raw materials, or we purchase materials. Of course, would be raw, because it's not a merchandising company that we don't purchase finished goods to sell finished goods. we have a manufacturing process in mind here. So we're going to procure raw materials, then add labor, add overhead, and all our equipment and machines, and the whole process that we have, the whole plant that we have established here is going to work towards those units that go through our processes. So we do a conversion job. We convert raw materials into finished products. So it's a cycle. All right. So the cycle begins with procurement of raw materials. So what's the entry? We say debit raw materials and credit accounts payable or cash. If you purchase on credit, it will be accounts payable. If you purchase on cash, it's cash. So upon procurement, what do? You issue those to different projects. We have those job sites, which I sometimes call projects. So when you issue it to a project, then the project, anything they receive, the bucket's name is work in process. So the project is receiving it as we issue of materials. I say materials, so it could be raw materials, it could be it could be direct materials, or it could be indirect materials as well. So if you issue direct materials, then debit work in process, credit raw materials. If you issue indirect materials, then it will be debit manufacturing overhead, because all the indirect materials, indirect labor, and indirect expenses would initially be loaded onto manufacturing overhead. Manufacturing overhead is a master account, and then we're going to slice it into by our denominator, like direct labor hour or direct machine hours, and then find out an hourly rate. And then based on the project's denominator level, like the projects or the jobs, number of hours, we multiply it by that rate. So initially, before application starts, initially all indirect expenses, indirect material, indirect labor, and indirect expenses, like utilities, like depreciation of factory equipment and everything will go to manufacturing overhead. So when you issue direct materials, you debit work in process, but when you issue indirect materials, you debit manufacturing overhead. We don't have it here. Then we have direct labor. As direct labor is added, again, debit work in process, and credit wages payable. Because labor we call wages, but if they are officers, then it would be, or other staff, it would be salaries payable. So wages and salaries payable is all fine. And then we have application. You can see manufacturing overhead, the other manufacturing overhead incurred. So it's direct labor. And then if there's indirect labor, I skipped it too. For direct labor, debit work in process. For indirect labor, debit manufacturing overhead. And then for all these other manufacturing overhead incurred, not applied yet, incurred, debit manufacturing overhead, credit, say utilities payable or all the expenses payable. And then as it is applied, we debit work in process and credit manufacturing overhead. See, at the time of application, it's assigned now to work in process, but until application, when we are all accumulating all of overheads, it was manufacturing overhead to debit. Now manufacturing overhead is being credited and debit is work in process. So by now, our direct materials have gone in, direct labor have gone in, and applied overhead has also gone in to work in process. So work in process has now three elements of costs: direct materials, direct labor, and a collection of all indirect expenses, indirect labor, indirect material, indirect expenses, apportioned in line with the denominator level of the project to work in process. All right. So that leads us to this. Now we are ready to calculate total manufacturing cost. So our total manufacturing cost, as I said, is basically a collection of work in process accounts. We're not doing the beginning and ending work in process adjustment yet, but just the three line items, the three basic elements: direct material, direct labor, and applied manufacturing overhead. Remember, applied, not incurred, applied one. So materials, for example, $100, labor, $300, and manufacturing overhead applied of $400. So that gives us $800 of total manufacturing cost. Now, total manufacturing cost and cost of goods manufactured are different, I told you. What makes it different? What makes them different? When we do work in process adjustment or inventory adjustment, work in process beginning and ending inventory adjustments, then we're going to get to cost of goods manufactured. So with this $800, just add beginning work in process inventory and subtract ending work in process inventory, you're going to have cost of goods manufactured. And once you have cost of goods manufactured, then do the finished goods inventory adjustments, meaning add beginning finished goods inventory and subtract ending finished goods inventory. When you added beginning finished goods inventory, you would have had a cost of goods available for sale. Then upon subtracting ending finished goods inventory, you would have cost of goods sold. So that's the end of the cycle. Now this cycle applies to many problems. Like in this assignment we have 24 problems. So the beginning ones are quite simple, small ones, and the ending ones, of course. So I decided to do the penultimate one, the last one being 24, number 24. So I thought I'd discuss number 23 with you. So let's go and see what number 23 has to say. In problem number 23, we have this company, Frøya Fabrikker AS, a company from Bergen, Norway. You can see this is the company, Frøya Fabrikker. All right, so it's about their problems, their accounting. So let me go over some of the information that's given there. It says that it's a small company, blah blah blah, mostly unimportant information. It says they use job order costing that applies manufacturing overhead cost to jobs on the basis of DLH, direct labor hours, that is, and its predetermined overhead rate was based on a formula that estimated $360,000 of manufacturing overhead for an estimated allocation base, which I call denominator, of 900 DLH. So your overhead, manufacturing overhead per hour, per direct labor hour, is going to be $400. All I did is I divided $360,000 by 900 direct labor hours. So I got $400 per hour. All right. And it also tells us that raw materials purchased on account, procurement, raw materials purchased, $200,000, raw materials used in production, all direct, $185,000. So you can always purchase more and use less, or vice versa, or not purchase at all and keep using if you have inventory, raw materials inventory in stock. So used in production was $185,000. Then utility bills incurred on account $70,000, of which 90% relates to factory operations. So 90% of the $70,000 is going to go to manufacturing overhead, and the remaining 10% is going to go to selling and distribution overhead, which is non-manufacturing cost. And then accrued salaries and wages cost for the period. Direct labor, 975 hours. So that's the amount of hours they worked. So when you apply, remember, although we estimated our hourly rate based on 900 hours, the $400 per hour came on the basis of 900 hours of work plan, but we actually worked for 975 hours. So when you apply, we're going to multiply 975 by $400, or we're going to, the other way around, we're going to multiply $400 by 975, not 900. Anyway, so our direct labor for that 975 hours was $230,000. Indirect labor, which goes to manufacturing overhead, is $90,000. Selling and administrative salaries, $110,000. It also says materials maintenance costs, maintenance costs incurred on account in the factory, $54,000. So maintenance cost, we know, goes to manufacturing overhead. Advertising costs incurred was $136. That goes to selling and distribution. Depreciation was recorded for the year, $95,000, of which 80% goes to factory equipment. So it relates to factory equipment. Anything that relates to factory goes to manufacturing overhead. Anything that doesn't goes to either general or selling and distribution overhead. Rental cost incurred was $120,000, of which 85% relates to factory. So 85% of $120,000. goes to manufacturing overhead, and the 15% of the same $120,000 goes to selling and distribution and administrative overhead. Manufacturing overhead cost applied, question mark, so it must be $400 multiplied by 975. And the cost of goods manufactured for the year was $770,000. We're going to calculate it and show and prove. And the sales for the year, all on account, was $1.2 million. So we know the entry for sales, debit accounts receivable, credit sales revenue, and the goods cost $800,000 according to job cost sheet. So cost of goods sold was $800,000. So debit cost of goods sold, credit finished goods inventory for the $800,000. So that's A to K. A lot of information in a breath. Now the balances in the inventory accounts at the beginning of the period, we needed beginning inventories, and we're going to also find, or would be given ending inventories as well. I said we're going to find because we're given cost of goods manufactured and cost of goods sold. So once these two are given, then we can actually find out ending inventories. Otherwise, ending inventories must be given for us to calculate these two, cost of goods manufactured and cost of goods sold. All right, so the beginning balances of the three inventories always, remember, RMI, raw materials inventory, WIPI, work in process inventory, and FGI, finished goods inventory, all three beginning and all three ending. So that makes it 6 total inventory information. Or another requirements, we are required to prepare journal entries to record the preceding transactions, post your entries to T accounts. I would say you can skip it. I don't mind if you don't do it, the T accounts, but it's also easy, or at least possible. Then prepare a schedule of cost of goods manufactured. I've done it for you. I'm going to show you. And prepare a journal entry to close the balance in the manufacturing overhead account to cost of goods sold. Closing the balance means if there is any overhead applied or under applied overhead, then please close it. Close it means if there is overhead applied, then take it off cost of goods sold. If there is under applied, then add it to cost of goods sold. Adding means debit cost of goods sold. Taking away means credit cost of goods sold. And the other part of the journal entry is, of course, manufacturing overhead. Prepare a schedule of cost of goods sold. So once you are up to cost of goods manufactured, then just 2 items, and 2 items later, you are on cost of goods sold. And what are those 2 items? One is add beginning FGI, and the other is subtract ending FGI. And then prepare also an income statement, which is simply the sales information minus cost of goods sold gives us gross profit, and then minus selling and distribution expenses, selling and distribution and general and admin expenses. All right, so let's see how we solve it. Requirement number 1, journal entries. So if you've seen the accounting cycle, haven't you? You have seen the accounting cycle. So debit, raw materials, credit, cash or accounts payable. That was the entry for procurement of materials. So let's go back and show you those. So let me go back to the questions, and I'm gonna keep pronouncing it in as short breaths as possible, because I want you to actually do some work yourselves. So when you watch this video, please have your pen and paper ready and also have the question ready. So I'm back on the question. All right, so what do you know here? We're told initially that they use direct labor hours as the denominator for calculating manufacturing overhead rate, predetermined overhead rate, POHR. So what's the formula? $360,000 divided by 900. That's the formula. So that gives us $400 per hour. So that's the calculation. But starting our journal entries now. Requirement 1. Pretty easy. It's a comprehensive problem, so it's going to be exhaustive, a bit long, but it is easy. All right. So what happens? The first one is A, raw materials purchased on account, $200,000. So debit raw materials or raw materials inventory, debit RMI, credit on account, credit accounts payable. You know the journal, debit raw materials inventory, credit accounts payable for $230,000. Sorry, $200,000. Number B, raw materials used in production. So that means we issued from that inventory of $200,000 worth of materials, plus we have had some beginning inventory as well there. So it would be more than $200,000 there in stock. From that stock, we issued $185,000 worth of materials to our project sites, to the different jobs or to this job, and all direct, no indirect materials there. So now materials going into production or into the factory. So debit raw materials inventory, RMI, debit raw materials, sorry, completely lost. So debit work in process, WIP, and credit raw materials. Debit work in process, credit raw materials. That's number 2, number B. Number C, utility bills incurred on account $70,000, of which 90% relates to factory. So debit manufacturing overhead, the 90%. So that is 90% of $70,000 is $63,000. So debit would be manufacturing overhead for those $63,000, and the remaining 7,000, 10% is going to be debit utility expense. These are expenses. Remember, we don't call it selling and distribution expense yet, but that it is in that broad category or administrative expense category. So debit utility expense. Remember, like simple income statement, normal financial accounting. So debit utility expense $7,000, debit manufacturing overhead $63,000, and credit would be utility payable or utilities payable, because bills are only incurred, we haven't paid it yet. So that's number C. D is accrued salaries and wages. Total cost is given below. Direct labor is $230,000. So all direct labor goes to work in process. So work in process debit. And here, it doesn't matter how many hours you worked, whether we work more than 900 hours or less than 900 hours, but I'm going to use, we're going to use the information that they have worked 975 hours. But no matter how many hours they worked, all the direct labor cost incurred goes to work in process, because labor cannot be stocked. You cannot store it. So there is no beginning or ending inventory of labor. Not possible. All right. So direct labor is debit work in process, $230,000. And then we have indirect labor of $90,000 for that debit manufacturing overhead. And then selling and distribution, selling and admin salaries, debit, $110,000. So selling and administrative expenses, debit, and credit, selling and administrative salaries payable, or say salary expense debit, salaries payable credit for the $110,000. That's the non-manufacturing costs. All right, so what about the direct labor and indirect labor? For direct labor, we debited work in process inventory, $230,000. Indirect labor, $90,000. We debited manufacturing overhead, $90,000. So let's finish it. And credit wages and salaries payable. 230 plus 90 makes it $320,000. And then for the $110,000 of selling and distribution expenses, of selling and administrative salaries, debit salaries expense debit, and credit salaries payable, $110,000. So that's our D. Number E, maintenance costs incurred on account in the factory, $54,000. So debit manufacturing overhead again for $54,000, and credit maintenance costs payable, $54,000. Then advertising costs incurred on account, $136,000. So advertising expense debit, and credit advertising expense payable, $136,000. The depreciation was recorded for the year at $95,000, of which 80% relates to factory. So calculate 80% of 95, and let's see how much it is. So that's $76,000. So for that $76,000, we're going to debit manufacturing overhead, because that relates to factory. And then for the remaining 20% is going to be 95 times 20 is $19,000. For the $19,000, we're going to debit administrative and selling expenses, and credit administrative and selling. Sorry, for both of them, the credit would be accumulated depreciation. So I'm back to G again. Depreciation was recorded for the year as 95. So credit accumulated depreciation is going to be 95. No doubt about it. Debit would be manufacturing overhead, $76,000. That's 80% that relates to factory. And $19,000 would be depreciation expense. So overhead part is going to be manufacturing overhead, and the selling and distribution part or admin part would be expenses, depreciation expense. Then rental cost incurred on account was $120,000, of which 85% relates to factory. or related to factory facilities. So again, debit manufacturing overhead for that $85,000 and debit rent expense for the remaining 15%, credit rent payable. They haven't paid it yet. Then manufacturing cost incurred, manufacturing overhead cost was applied to jobs. So applied would be $400 times 975. So $400 times 975. So that gives us $390,000. So this is overhead applied. So when we apply overhead, it goes to work in process. So debit work in process, this is number J. Debit work in process, credit manufacturing overhead, $390,000. Now job cost of goods manufactured for the year was $770,000. We are going to find out that there's no entry for cost of goods manufactured. There is an entry for cost of goods manufactured. The cost of goods manufactured goes to the finished goods inventory. So debit finished goods inventory and credit work in process. Cost of goods manufactured means manufactured and transferred to finished goods. So debit would be FGI, finished goods inventory, and credit would be raw materials inventory, RMI, work in process inventory, work in process. Then number K, sales for the year was $1.2 million. I think I already mentioned it. So debit accounts receivable and credit sales for $1.2 million, and then cost of goods sold was $800,000. So debit cost of goods sold and credit FGI for the $800,000. We are given the beginning work in process, beginning raw materials work in process and finished goods inventories. We are not given closing ones because the cost of goods manufactured and cost of goods sold, those two are given. So once those two are known, we have to work backwards to find out ending work in process and ending finished goods. All right, so we have done requirement 1, preparation of journal entries. And I said you skip number 2, now prepare a schedule of cost of goods manufactured. So let's come back here. This is what, well, I wanted to show you a little bit of this because this was my working. So you can see initially we calculated predetermined overhead rate, which was $400 per DLH. Then I wanted to calculate the 3 elements of cost. So raw materials used was $185, direct labor used was $230,000, and the manufacturing overhead. This is not manufacturing overhead applied. This was the elements of manufacturing overhead I extracted from each item. So indirect labor, maintenance, depreciation, the factory component, rent, the factory component, utilities, the factory component. So if there's combined elements like salaries, wages, rent, utilities, depreciation, so just pick up the factory component, the manufacturing component to calculate your manufacturing overhead. So total manufacturing overhead you can see is $385,000, but overhead applied was $390,000. So of course that was overhead applied, and overhead applied means you're applying something that's not there. See, total manufacturing overhead accumulated was 385, but luckily we worked more hours and we ended up applying more. So more applied means we're not going to spend it. So we saved some money there, and that you'll see when you close it, we're going to credit cost of goods sold. So there'll be reduction to cost of goods sold. Anyway, so these 3 are the total. This is the total manufacturing overhead, but applied was 390. So materials used, labor used, and applied, these 3. This one, though, this one, not this one. This one plus these 2 is our cost of goods, total manufacturing cost. That is total manufacturing cost. You can see applied was 390, so over applied was 5,000. So that means that leads us to this. So the 3 together, raw materials used, labor used, and yeah, of course, this raw material is direct material. So direct material, direct labor, and manufacturing overhead applied, not manufacturing overhead accumulated, applied 390. So that gives us total manufacturing cost. Plus beginning work in process inventory was given in the question, gives you total manufacturing cost to account for. I like it. Total beginning work in process plus all the resources that we put in the process is what you need to account for. So total manufacturing cost we need to account for is $826,000. Then we have something in our ending work in process inventory, which was $56,000. That gives us cost of goods manufactured to be $770,000. Now this 56 was not given to us. You keep reading, read through the question, you won't see that. So we have to work backwards because we were given this. So you were, at this level, they expected you to be able to do some forensics. So cost of goods manufactured was given, but normally your ending work in process inventory would be given. So you add beginning inventory of work in process and subtract ending inventory of work in process, and you would end up with, you'd find your cost of goods manufactured. So that is the difference between total manufacturing cost and cost of goods manufactured. The only difference is that we are doing work in process adjustments, inventory adjustment, and then add beginning FGI, which was given in the question. I can tell you how much was. Beginning finished goods was $60,000 and ending finished goods wasn't given. So let's add the $60,000 to it. So if we add 60,000, we're going to have, so it's $770,000. If you add 60,000, you'll have $830,000 of cost of goods available for sale. Cogas, cost of goods available for sale is 830. Then what is minus ending finished goods would be cost of goods sold. So ending finished goods wasn't given. We are given the ultimately we are given the cost of goods sold information. They told us that the cost of goods sold was $800,000. They said that the selling price was $1.2 million, but the cost of those goods was $800,000. So if we use that, see, I'm going to show you how to work backwards. So I'm going to complete the cost of goods sold as 800,000, and you know that how much you have to subtract from 830 to get to 800. Of course you do. So cost of goods sold is actually $800,000. So now fill in the blanks. Fill in the blank here. So your cost of goods sold final number is 800,000, but Cogas was 830. So how much is your ending FGI? How much was it? Must be the difference. So the difference is $30,000. All right. So we not only have the cost of goods manufactured schedule here, we have the cost of goods sold schedule here, the full schedule here. Raw materials used, then direct labor used, manufacturing overhead applied. Okay. Then in the complete schedule, it's customary to begin with raw materials inventory, beginning raw materials inventory plus raw materials issued minus ending raw materials. So I think it would be better off saying it that schedule, how much raw materials have been used, direct materials used in production is $185,000. Yeah, but raw materials issued purchases was 200,000, and raw materials, of course, they had beginning raw materials that was $30,000, and then raw materials ending inventory was 45. So direct materials used in production was 185, and that 185 was actually given in the question. We're told that raw materials used in production 185. So they saved a lot of work for us. Normally, raw materials used is not given, and we don't care. I mean, we don't mind if it's not given. We know how to calculate it. In that case, it would be, instead of starting straight with $185,000, you'd say beginning raw materials inventory, whatever that was. I can tell you how much that was. Raw materials at the beginning of the period was $30,000. Then raw materials purchased was how much? 200,000. So 30 plus 200 makes raw materials available for use 230 minus raw materials ending inventory, not given though, doesn't matter. Why I keep saying doesn't matter? It means we don't mind, because my beginning inventory was 30,000. Then I procured $200,000 worth of raw materials, so I have available of 230. And then if I used 185, then the unused portion must be there in my ending inventory. So available for use was 230 raw materials, that is, and used is 185. So the difference, the $45,000, is raw materials ending inventory. All right. So that's what is there. All right, so we have now prepared the schedule of cost of goods manufactured and prepare the journal entry to close the balance of the manufacturing overhead. So I've shown it here. I told you that there is over applied, so that's only one journal entry. If it's over applied, that means we have to take it off cost of goods sold. You can see our total manufacturing overhead accumulated was 385, but we applied 390. So we have some saving there. Our cost was actually 385. So take it off cost of goods sold. So debit manufacturing overhead, in other words, put that, make it, force it to zero. Manufacturing overhead cannot have any balance. All manufacturing overhead must be eventually loaded to cost of goods sold. So debit manufacturing overhead and make it 390 because we applied 390. So 390 minus 390 would be zero. So nothing would be left in manufacturing overhead account. All would be transferred to the processes, work in process, and then eventually to finished goods and cost of goods sold. So the entry is going to be debit manufacturing overhead and credit cost of goods sold. Remember, the easier way to remember is that if you have over applied, which is a good news, reduce your cost of goods sold. So cost of goods sold is a debit account. To reduce it, we have to credit it. So if I credit cost of goods sold, I need to find something to debit. I need to plug that debit hole, and I'm going to plug it by manufacturing overhead. If there was under application, then with debit cost of goods sold and credit would be manufacturing overhead. Remember, before you end the problem, before you leave, before you go home, your manufacturing overhead applied and manufacturing overhead accumulated must be equal. That means over or under applied must be eliminated, must be killed. All right. Okay, and finally, prepare an income statement. So I'm going to show you the income statement. Our cost of goods sold. How much was our cost of goods sold? Our cost of goods sold here was $800,000. 800,000. But if we take the $5,000 off, remember, for over application, so then say minus over applied overhead $5,000. So the adjusted cost of goods sold is going to be $795,000. This is before the $5,000 over or under application adjustment, or in our case, it was over application. All right, so that means our cost of goods sold eventually, our final cost of goods sold is going to be $795,000. So that leads us to the income statement. So our sales was $1.2 million, cost of goods sold 795. That leaves us with a gross margin of $405,000. And now subtract all the administrative and selling and distribution expenses. Remember the costs, the expenses that you did not or could not load to manufacturing overhead. Remember, for example, in rent, 85% or 80% was due to factory, due to production. The rest was admin or selling. So those components, utilities 10% was selling and distribution and admin. Depreciation was 20%, admin and selling. Rent expense was, I think, 15%. So those advertising expense was completely selling and distribution. So advertising 136, utilities 7, salaries expense 110. The selling and distribution salaries, remember, whole line item was selling and distribution salaries, so we call it salaries expense. The depreciation expense, $19,000, the non-factory component, and rent expense, $18,000. So all those together is total, those operating expenses is $290,000. Subtracted from a gross margin of $405,000, we have operating income of $115,000. So that ends this so-called long problem. So how do you feel? Is it still too bad, or sounds at least something that you can now chew? We've tried to break into small pieces so that you can chew and eventually digest. I'm sure you can. I mean, if I can, you can too. Because I was not originally an accounting student. I was a finance student for all my university life. I was a finance student, and as a finance student, I finished my master's. I finished my honors undergrad as a finance student. So there we did only limited accounting. I did accounting, but I did limited accounting because the focus was on finance. Then in my PhD and eventually CA, Chartered Accountancy, that is my accounting qualification. But more importantly, it's practice. I've been practicing for decades, and still I fumble. Still I cannot do it off my fingertips. So it's completely understandable that however talent God has gifted you with, it will take time. You will have questions. But remember, the cycle, the accounting cycle is very important, the job cost accounting cycle, because this is the thrust of chapter 3 is letting you go through the accounting of it. So remember, our step 1 is procurement of materials, direct and indirect, doesn't matter. So debit raw materials inventory, RMI, credit accounts payable or cash. Then issue it to different project sites. Debit work in process, credit raw materials. So debit work in process for the direct ones and debit manufacturing overhead for the indirect ones. Then add direct labor, debit work in process again. Add indirect labor, debit manufacturing overhead. Add other expenses, debit manufacturing overhead. Add selling expense, debit selling expense. Don't call it an overhead. Add rent expense. If it's related to factory, all of it goes to manufacturing overhead. If it's not related to factory, it goes to rent expense. Depreciation of equipment, machinery, buildings, property, plant, and equipment, all these. If it's related to factory, debit factory manufacturing overhead. If it is not related to factory, it's called depreciation expense. Same is true for advertising expense, which is, you can't have advertising for factory, for manufacturing. So it's all selling and distribution. But salaries could be admin salaries, could be factory salaries. There are salaried people who are in charge of manufacturing. All right, so all this manufacturing overhead is added under manufacturing overhead account. Then we separately we find a total, the total amount applied would be based on the actual hours. So when you apply, not everything is estimated. The rate is estimated, but the number of hours is actual. The denominator is actual. Like in this case, question 23, we made our estimates based on 900 direct labor hours, but we applied based on 975 hours because that was the actual hours worked. So manufacturing overhead applied is actual hours worked times predetermined overhead rate, which is $400 here. So 975 times 400 gives you the total amount of overhead applied, which was, I think, $390,000. But on the other hand, we have been separately accumulating all our factory manufacturing overhead items, right, from utilities, depreciation, salaries and wages, utilities, indirect expenses, all those indirect things. All right. So that's manufacturing overhead 385. Then applied was 390. So that means work in process received 390. Manufacturing overhead gave 390, but manufacturing overhead doesn't have 390. It had only 385. So we're going to fix it later. We'll take the $5,000 off our cost of goods sold and load it to manufacturing overhead. So we'll debit manufacturing overhead again to make it competent to be able to give $390,000 to work in process. That's what it is. So total manufacturing cost is direct materials used, remember, used in production plus direct labor incurred plus manufacturing overhead applied. So that's total manufacturing cost. And then plus work in process beginning minus work in process ending is your cost of goods manufactured. Then plus finished goods beginning minus finished goods ending is cost of goods sold. And then if there's an over under applied, then cost of goods sold will be debited again for under applied and will be credited for over applied. And the other component would be manufacturing overhead in that over under application adjustment entry. And then we have sales. You sell it, accounts receivable or cash, and credit sales revenue. And then of course you sell something, what you are selling must have a cost or must have had a cost. So debit cost of goods sold, credit finished goods inventory for that. There would still be things in the finished goods inventory. It cannot go negative, meaning you cannot sell something which you haven't manufactured or which is not finished yet. So that's the whole cycle, and that's actually a whole chapter, I tell you. All right, I hope you enjoyed it, and I hope you are going to find it useful. And that's more important. I don't care about enjoyment as much as I do care about having it work for you. So if it works for you, then you're going to enjoy it one day. And even if you don't, there's no hard feeling. We don't enjoy everything, but we do a lot of things. All right. I hope to see you again with maybe other problems from chapter 3. But I would really like you to start this assignment. And the due dates are still off, a few days, but you have to start with something. All right. Okay, have fun. Enjoy your weekend. Bye-bye.